the falling knives you want to avoid right now, and the 3 names in tech where there's true momentum ahead. Joining us now is one of our favorite guests, longtime Wall Street veteran Marc Chaikin, sharing what to buy and what to avoid in the stock market right now. Marc, so glad to have you on. I'm really excited to get your take on what's happening in the market right now, because it's also interesting to see new all-time highs happening at the same time. Some of the biggest tech sectors are bottoming out. They're dropping with no end in sight. Marc, let's start out with talking about what's happening in software. Do you think this downturn has some real legs to it?
I do. Part of that is the psychological impact of seeing some of our favorite stocks over the last 20 years in very steep downtrends, while the S&P 500 and the Dow are making new all-time highs. But let's take a step back in time, if you will. In 2018, Mark Andreessen, who created the Netscape browser, which touched off the internet boom of the 90s, something people are comparing to the AI boom that we're experiencing, famously said in an article in the Wall Street Journal that software was eating the world. And he was right. For the next 15 years, software, particularly the SaaS, software as a service model, has proven to be the source of a lot of very profitable investments and trades for almost anybody who follows the stock market. Now you've got ChatGPT and Claude. And because of the new advances, particularly from Claude in the last 2 weeks, investors are concerned that these embedded software programs that have become very much a part of our lives, our business lives, our personal lives, are under attack because you can build these yourself. Claude came out with their new product a week and a half ago, and it's a product that's a multitasking, multifunctional business product. That's the fear that's coursing through the market right now. How can stocks like Adobe, like Zscaler, like Palo Alto Networks, how can these stocks maintain their price points and their business model if you and I can sit there and use a product that we build on Claude or ChatGPT for nothing? It's a big threat.
I want to dive into the controversy on this discussion, though, where some people say, yeah, but the profits are still there for these companies. And yes, the demand is still there. Companies move rather slowly, especially large corporations, and they have these softwares embedded into their business model. And it's going to take time before they're going to just drop those softwares and move to something they build on AI themselves. What do you think about that argument?
I think that's a valid argument with a caveat. The caveat being that there are some companies like Roblox, for instance, which give you the tools to build games and apps that could become much more vulnerable than, say, a Salesforce.com, which is a stock that we like going into 2026, sort of flying in the face of what was already a weak software group. But Salesforce is deeply embedded in our company. We use it to process sales, to keep track of customer support requests, to slice and dice our database to better serve our clients. I don't think a company like Salesforce.com is going away, but companies like Roblox are going to be challenged going forward. Companies like Doximity in the medical records field, where most of the doctors in America have signed up for Doximity software, they're starting to hit a revenue wall. Their last earnings report. Someone else can create a Doximity knockoff using Claude. There's no barriers to entry in software except the installed bases. So I'd say companies with very large installed bases like Adobe, like Salesforce.com, like Palo Alto Networks, which all have bearish ratings right now, will survive. The question is, how much will investors pay for them going forward? Will they pay the premium price earnings ratios that they've been used to paying for high growth software companies with high profit margins because of the SaaS business model?
Yeah, you said bearish ratings there, and that's on the Chaikin Power Gauge. I know we've had you on the show a lot of times, so if you watched before, you've seen this. But if you have not heard of Chaikin Analytics Power Gauge, we have a QR code here or a link in the description for you to look into Marc's system that he has used for decades now to find success on Wall Street, really ranking stocks that are bullish and bearish and finding when that momentum is really into play. And that brings us right back to the discussion on software. I think a lot of people are looking at some of these really big names, even Microsoft, that are down at levels they haven't been at in years before, wondering, should I buy the dip right now? On any of the names that you mentioned, really any stock in software, would you buy the dip at all, or is there any chance of a recovery for some of these names?
Well, there's a chance of recovery. The question is when. No, I would not buy these stocks right now. It's the proverbial catching the javelin. You try and catch the javelin and you end up with a bloody hand. It's not easy to do, painful. So I think it's too early to step in here. Microsoft filled a gap that goes all the way back to last March. Last April. And I don't think people thought it was going to fill that gap, but it has. And the damage is too big to reverse in just a day or a week, Bridget. That's my view on this. They're not dead, but there is another area in tech that I think is very much alive.
Yeah, and that's what we want to get to today. The three names in tech where there's true momentum happening, where there is bullish indicators on many, many fronts for these names. Let's get right into it. Let's get to that first stock in tech right now that you are seeing a lot of momentum and promise, and staying away from software where 10, 15 years ago, software were the bullish names. Now this is the new area of bullishness to look for in tech investing.
Let's look at the predicate here. The whole AI boom is fueled by data centers. You need data centers to run AI software. In order to run data centers, you need chips. And most of the chips, as we know, are coming from NVIDIA. Some are coming from AMD. What's the worst thing that can happen in a data center to a chip? It fails. The chip isn't built to withstand the intense heat. There are flaws in it. So you have quality control companies, and that's our favorite right now, a company called Onto Innovation, symbol ONTO. They make the machines and the software that make sure that the chips are reliable. So it's a nice nuts and bolts business that gives you the ability to participate in the growth of AI through chip data center quality. And it's my favorite tech stock right now.
And this chart looks nothing like the charts of the software names that we've mentioned earlier on in this video. Let's talk about what kind of price action and interest and even what analysts are saying about this stock right now.
Onto is a $10 billion market cap company. They make this critical testing equipment. The chart looks fabulous. The stock broke out back in December, really in off a triple top at the 140 area, rallied all the way up to 220, and then had a significant pullback. And this is when I like to buy them, back down to 182. Now it's rallied back up and is forming a double top. I don't want to pay up for these stocks because there's no need to. They're volatile enough that they give you a second look. So I'm looking to buy Onto on a pullback because it's in a very strong uptrend with positive Chaikin money flow. It's at the top of my watch list right now.
Interesting. One other question before we move on to the next name. I know there's a couple of other names that have come on the channel in the past on this similar concept. So I'm curious about competition. Is there a growing pool of different names out there that are getting a lot of business right now who are doing similar testing of these chips and semiconductors and data centers?
There are, but they tend to be much smaller companies with specialized niches and not as big a customer base as someone like Onto. So there's always going to be competition, unless you have a monopoly on something, and the world frowns on monopolies these days. So I look for a company that's got an installed base entrenched in an area where it's not easy to switch over. They've got a bit of a moat, as Warren Buffett would look for, around their business because the data center build out is moving so fast that there's not a lot of room for experimentation.
Yeah, it is all moving so fast right now. And that's why so many of these names that we're talking about now are the ones with all of the momentum because there's so much money flowing to this area right now. Let's get on to the second name that you're looking at in tech right now that still has a lot of momentum and positive bullish indicators right now.
And that would be Amcor Technologies, symbol AMCOR. They are also in the test services business, but they also package semiconductors. They do outsource packaging. So it's a slightly different company than Onto Innovation. The chart looks very much the same, a big spike up back in January. I think it's important for the viewers to realize that on Friday in January, Taiwan Semiconductor had a fabulous report, much better than expected. And all of these semiconductor stocks spiked up. It wasn't company specific, it was all of them. Maybe the shorts were covering, maybe people made the connection between Taiwan, which is the world's largest manufacturer of semiconductor chips, and what it would do on a coattail sort of analogy to these other companies. So they all spiked up and then they pulled back when a little bit of reality set in. But the good news is they've now, in the main, rallied back up to those mid January peaks. And that tells me that the buying is real and based on a change, improvement in fundamentals because the chip industry is just en fuego. It's really hot.
And this is almost the exact opposite conversation in the software sector. This is the entire semiconductor sector doing really, really well right now. Is it kind of like software where you can buy almost anything in semiconductor and see it do well? Or do you really want to look at some of these specific names, like the three that you're looking at with us today? And how do you choose in a very large sector with lots of different names, which are going to be the best investments to make in a very bullish, booming sector as a whole?
It starts for me with a top down approach. And I'm not looking for the largest names because everybody knows who they are NVIDIA, AMD, Micron. I'm looking for mid cap names. So that narrows the playing field a little bit. Must have a bullish power gauge rating. Then I look at two other things. This is really simple. I'm looking at how a stock's doing compared to the market, compared to the S&P 500. I want a stock that is outperforming the market. Absolutely. Don't not looking for turnaround plays in tech. And then I'm looking for stocks where Chaikin money flow is green, telling us that smart money is buying the stock on dips. So if those three things are in place and the stock is in a well-defined uptrend, and the easiest way to define an uptrend is higher highs and higher lows over a period of 3 months. You have a stock like Amcor, like Onto, and like a third stock we're going to talk about that's making higher highs, and then when it pulls back, higher lows. That's a stock in an uptrend. So four things to look at. Really simple. You can do it on any chart, but we just have a much slicker user interface, and we do a lot of the work for you in terms of how we set up the screens. You don't have to tinker a lot to use Chaikin.
It really is very easy to use. I like visiting the site and looking at what the Power Gauge has to say about stocks. If you want to look at that yourself, we have a QR code here and a link in the description, and we'll put one in the comments too. If you want to look at that interface for yourself and check out what the Power Gauge has to say about stocks, again, it's a really good technical way to look at some of these names and look for those indicators that Mark just mentioned. That was such a good breakdown of how to choose which stocks in a bullish sector. I really like the time frame that you put on there, looking at it over 3 months and looking for higher highs and higher lows. Very great advice for investors. I am excited to get to this last name on your list too, though, because this is another name that we haven't talked about too much on the channel, but I think it's one that has seen a lot of bullish activity right now.
Well, the third stock in the semiconductor group is Enphase. Having just said that we're not looking for turnarounds in tech, Enphase is a turnaround stock because their semiconductors are used in solar panels. But guess what? Even though their product line is geared toward home energy solutions, data center build out makes energy alternatives very, very important. In fact, I think you're going to see data centers with partial solar generation of energy. And that means companies like Enphase could see a big expansion into new markets. But for the time being, energy is important in data center buildouts. The problem with Enphase is it was underperforming the market until about a month ago. That's where the concept of relative strength comes in. Even though Enphase had a bullish power gauge rating, I was not interested in Enphase as a stock because the relative strength was weak. Now that the relative strength has picked up, In other words, the stock is now starting to outperform the S&P. So one of our screens picked it up about 3 weeks ago. We've been monitoring the stock. They had a great earnings report about 7 days ago. The stock is starting to settle down a little after spiking up over 50. These are the ideal setups for me. You're not chasing a stock that's at an all-time high, but you are looking for a stock in a strong industry group with positive earnings reports that's now putting in that pattern of higher highs and higher lows.
Yeah, I think this one's a really unique name because not only is it a semiconductor stock, it's really in that energy sector too that we're seeing so many headlines about right now. I feel like there's a headline every other day about rising energy cost, even just for general consumers and residential homeowners. Then there's the AI piece of energy as well. And so the demand for all kinds of energy is soaring right now. We've seen that in Bloom Energy, another alternative energy stock that just went wild. And so it does make sense that this stock would be of interest right now.
The difference between Bloom, which I like, but haven't been able to find a comfortable buying spot, is that Bloom does about 2 million in revenue, but has a market cap, 2 billion, of $43 billion. So it's selling at 20 times revenues. Enphase, on the other hand, does about $1 billion in revenue, so it's half the size of Bloom, billion four, so it's maybe three-quarters the size of Bloom. Market cap is only $6 billion, so it's only selling at 4 times revenue. Bloom is selling at 20 times revenue. That doesn't always translate to negative returns at high price to sales ratio, but it's like you're on a high wire without a safety net if something goes wrong.
Oh, such good advice. A good analogy between the two. Always important to look at that PE ratio as well. Before we go, I want to just get your thoughts on the broader market. It feels like this sell off isn't just in software, it seems to be really a market rotation out of tech in general. You've mentioned some really good names that are still very bullish in tech, but what are your thoughts on the market as a whole and some of this rotation that might be happening?
The market, Bridget, is playing out the midterm election year script perfectly so far. The midterm election year is the weakest year of the 4 years of the presidential cycle. On average, it's up 5%, whereas all the other 3 years in the cycle are up double digits. The strongest being next year, 2027, which is the post or the pre-presidential year. Typically, in a midterm election year, you see a sell-off in late September as people start to see what the election outcome is likely to look at, and maybe get a little nervous. Maybe there's some uncertainties about policy changes and so forth. So right now, we're playing to strength. I'm not going to turn bearish unless and until the market tells me to, and that would require some serious deterioration in terms of breadth. All that sector rotation you're talking about is very healthy for the overall market. We've finally moved away from the Mag 7 and the hyperscalers and the big tech companies to the cyclical companies, financials, industrials, energy, surprisingly, and pharma. So I think the market is very healthy. I'm going to stay with it and find the best stocks to buy in the strongest sectors and industry groups. But there will come a time in 2026 when caution is going to be important and playing defense is going to be important. We're just not there yet, in my opinion.
A good outlook for the year and something for people to keep in mind. We'll hear from you again, Mark, next month to see if anything has changed on that market outlook. If you want to catch another contrarian view on the software sector, where there are some people still bullish on the future of some of these software stocks, make sure to watch this video too.